In the world of finance, there's a concept that is mentioned very often: liquidity. Many investors hear this word again and again, yet most people don't fully understand what it actually means. However, liquidity is one of the most important keys to understanding how financial markets truly work. In fact, many of the price movements we see in markets are closely connected to this concept. In simple terms, liquidity describes how easily and quickly an asset can be bought or sold in the market. When a market has a large number of buyers and sellers, transactions happen quickly and smoothly. In these situations, prices usually move in a more stable and balanced way. Markets like this are considered highly liquid. High liquidity allows investors to enter or exit positions easily without causing major changes in price. This creates a more efficient and stable market environment. On the other hand, when a market has very few buyers and sellers, liquidity becomes low. In low liquidity markets, even relatively small trades can move the price significantly. This happens because there are not enough participants on the other side of the trade. As a result, markets with low liquidity often experience higher volatility and sharper price movements. Liquidity becomes especially important when we consider the actions of large investors. Institutional investors such as hedge funds, banks, and large financial institutions sometimes execute trades worth millions or even billions of dollars. For trades of that size to happen smoothly, the market must contain enough liquidity. If there are not enough buyers or sellers available, these large transactions can push prices up or down very quickly. Because of this, large investors rarely place trades randomly. Instead, they often look for areas in the market where liquidity is concentrated. But where does liquidity usually accumulate? In many cases, liquidity forms in areas where a large number of traders place their orders. One of the most common places where this happens is around stop-loss levels. Many traders tend to place their stop orders at similar price levels, often just above resistance or just below support. When this happens, a large number of orders become concentrated in those areas. For example, if many traders place their stop losses below the same support level, a significant pool of liquidity forms in that region. When price approaches that level, a large number of orders can suddenly be triggered. This is why markets sometimes move quickly towards certain price levels. To inexperienced traders, these movements may appear random or even unfair, but experienced traders understand that these movements are often driven by liquidity. Large market participants need sufficient liquidity in order to execute their trades efficiently. Because of this, price sometimes moves toward areas where large clusters of orders exist. This also explains why markets sometimes behave in ways that seem illogical. Price may suddenly move in the opposite direction of what most traders expect, or briefly break important levels before reversing. In many cases, these movements are part of the market searching for liquidity. For this reason, experienced investors do not analyze markets by looking only at price movements. They also try to understand where liquidity might be located. Because large capital rarely moves randomly, most of the time, big money moves toward areas where liquidity exists. Understanding this concept can completely change the way someone views financial markets. Because behind many price movements on a chart, there is often an invisible force at work. And very often, that force is liquidity.